Bismillahirrahmanirrahim. In this video, we will solve an exercise on interpreting the alternative decomposition of return on capital employed with negative net financial obligations. So here is the exercise. Suppose an analyst reformulates financial statements to prepare the alternative decomposition of ROCE for a firm with no debt. There is no debt in this firm. The analyst, all the capital is going to be financed by equity, etc., but not debt. The analyst determined that the company holds excess cash as large marketable equity securities. The result will be net financial obligations that are negative. Now, if you don't have an idea about negative leverage or operating income, please watch my videos I have already uploaded. Now, assume that operating ROA is positive and large. How will this affect the decomposition of return on capital employed? Oh, there is an typing error. So, return on capital employed is equal to operating ROA, and this is going to be plus leverage times. So ROCE is equal to operating return on assets plus leverage times spread. So how do you interpret the net borrowing rate for this firm? And that's the same formula has been stated over here as well. ROCE is equal to operating ROA plus leverage times spread. Now, the return on capital employed is an important profitability metric that shows how effectively a company uses its capital to generate profits. The general decomposition of ROCE into its components can help us understand the underlying drivers of the company's performance, that is operating ROA and leverage and spread. So ROCE, that is return on capital employed, it measures the ability to generate profit from its capital investments. So ROCE measures the company's ability to generate profit from its capital investments. Operating ROA, that is operating return on assets, it reflects the company's operating efficiency, excluding financial activities like debt and financial investments. Just keep this thing in mind that when we are talking about operating return on assets, we are not going to take into account financial activities like debt and financial investments. Now coming to leverage, this represents the financial leverage, typically calculated as the ratio of debt to equity. And then finally, we have the spread, which is the difference between the return on financial assets, like return from interest on debts or investments, and the company's cost of capital or interest rate on debt. Now, if a company has no debt, but holds excess cash, especially in marketable securities like equity investments, this can have a significant effect on ROCE decomposition. And so let's break down how this negative net financial obligations, that is holding more cash than debt, influence the components of ROCE. And here we have taken a hypothetical example. Here we have a manufacturer and that sells consumer electronics. And here is the financial profile. We have the operating income, we have total assets, debt is 0, excess cash is 10 million and equity is 30 million. So the first step, as you can see, is we have to look into the ROA, return on operating assets. So let us calculate the ROA. Now, ROA is a measure of how efficiently the company is using its assets, excluding financial activities like debt. So, operating ROA, this is equal to EBIT, earning before interest and taxes, divided by the total assets, and this is going to be equal to EBIT 8 million divided by the total assets, that is 40 million. So if you calculate, this is going to be equal to 0.20, or we can say 20%. So operating ROA is 20%. This means that the company generates a return of 20% on its assets from its core operations. Now, the second step is we are going to look into the leverage and the spread. You can see that ROCE is equal to operating ROA plus leverage times spread. So next step is we will calculate the leverage and the spread. Now, since the company has no debt, so obviously the leverage is going to be 0. Now the spread, which is the difference between the return on financial assets like interest income from cash holdings and the company's cost of capital, this needs to be considered carefully. Uh, However, like if you look into this case, the company is holding 10 million excess cash, which is earning a return, for example, through interest on bonds, dividends on stocks. Now, this return from financial assets affect the company's spread. So, let us assume that the company return on these 10 million in excess cash is 5%. So, the company is going to earn 5% on this 10 million. This is going to be equal to 500,000. They are going to earn 500,000 from its marketable securities. In addition to this, let us assume that the company's cost of capital is say 8%. Now, we take the cost of capital as 8%. So, the return on financial assets this is going to be, as I said, 5% of 10 million, that is 500,000, and the cost of capital, if we are assuming 8% based on equity or debt, so the cost of capital is 8%. And now we can calculate the spread. Now, spread, as I have already said, this is the return on financial assets minus cost of capital. So, return on financial assets we have already just now calculated, that is 500,000 minus cost of capital, we are having 8%, and 8% on the equity, that is 30 million. So this is going to be 2,400,000. So this is going to be negative 1,900,000. Okay. Now, since the spread is negative, this means that the return from the company's excess cash is not enough to cover its cost of capital. So the return on capital employed we are going to calculate. So ROCE, uh, that is the operating return on assets, and that is 500,000, sorry, 20%. And to this we are going to have the leverage, and the leverage is 0. The debts, you can see, already see, is 0, so the leverage is 0. And from this we are going to multiply the spread, and the spread we have already calculated, minus 1,900,000. So that is 20% plus 0, and 0 times minus 1,900,000 will give us again the 0. So that is equal to 20%. So the ROCE is 20%, which is the same as the operating ROA because the leverage is 0. So what does this mean? The operating return on assets of 20% indicates that the company is very efficient at generating profit from its core assets. It has no debt, which means it doesn't pay any interest and doesn't need to use leverage to amplify the returns. Despite having excess cash, the company's ROCE remains unaffected because there is no debt. However, this excess cash earning is less than the cost of capital. You see, we have assumed that the cost of capital was 8% and the return was 5%, leading to a negative spread. Now, negative spread occurs because the company is earning 5% on its excess cash, but its cost of capital is 8%. This means that the cash holdings are actually diluting the company's overall return because they are not earning enough to meet the required return for investors. So coming to in the end, a general impact of excess cash on ROCE decomposition. ROCE as a profitable metric. So if a company has excess cash but no debt, the ROCE can still be high if the company's operating efficiency is strong. However, the excess cash can create a drag on ROCE if the return on investment is lower than the cost of capital. The leverage becomes a non-factor if there is no debt. So the second term, that is leverage into spread, disappears. The company's overall performance is then solely driven by its operating returns on assets. Even with excess cash, the company could experience a negative spread if the returns from its financial assets are lower than the company's cost of capital, and this may indicate that the company is not effectively deploying its cash to generate higher returns. Companies that accumulate large amount of excess cash, especially when it's invested in low yielding assets, may need to consider whether it is better to use the cash for growth investments or share buybacks rather than holding it in marketable securities that are underperforming relative to the cost of capital. So to conclude, in this case, the company ROCE is strong. If you can remember, that is 20%. The presence of excess cash and the resulting negative spread suggests that the company is not using its cash effectively. The 5% return on cash is lower than the company's 8% of capital, which means that its excess cash is dragging down its overall profitability. So even though ROCE remains solid, that is 20%, the company may need to rethink how it is managing its excess cash, as its current strategy of holding cash in marketable securities is not contributing positively to the overall return. So, we hope that we are able to clarify how excess cash and negative spread can affect ROCE decomposition. And this completes the video on interpreting the alternative decomposition of ROCE with negative net financial obligations. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. We hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is a K. Thank you so much and happy learning.